What if I told you that there's a secret playbook used by the world's wealthiest investors that has predicted and profited from every single market crash for the past century? Not theories, not lucky guesses, but a mechanical three-step process that turns financial disasters into personal fortunes. And right now, as I speak to you in January 2026, these exact same three moves are being executed by billionaire investors who know something the rest of us don't. When Joseph Kennedy saw the warning signs in 1929, he didn't just survive the crash that wiped out 90% of the market. He walked away $50 million richer while millions lost everything. Paul Tudor Jones used the identical strategy in 1987 and made $100 million in a single day during Black Monday. Michael Burry, John Paulson, and others followed the same blueprint before 2008, turning billions in profit while the global financial system nearly collapsed. These weren't coincidences. This wasn't insider trading. This was pattern recognition at its finest, and the pattern is repeating right now. Warren Buffett is sitting on over $300 billion in cash, the largest cash position in corporate history. Central banks worldwide are hoarding gold at unprecedented levels. Hedge funds are quietly building massive positions that only pay off when markets crash. The smart money isn't gambling. They're following a script that's worked 4 times over the last 100 years. Let me show you exactly what these 3 trades are, how they've generated fortunes during every major crash, and why the fact that they're being executed right now means we're looking at a market collapse within the next 12 to 18 months. Once you understand this pattern, you'll have a choice. You can ignore it like most people do and watch 30 to 50% of your wealth vanish. Or you can recognize where we are in the cycle and position yourself accordingly while there's still time. The reason it is always 3 trades and not 2 or 5 or 10 comes down to the mechanical nature of market crashes themselves. Crashes aren't random events. They're system failures that happen in predictable phases, and each trade addresses a specific vulnerability. Phase 1 is recognition. This is when sophisticated investors realize that asset prices have completely detached from economic reality. The potential gains no longer justify the enormous risks. The mathematics have broken down. This is when you convert everything to cash, preserve what you've made, and exit before the destruction begins. Phase 2 is preservation. While cash protects you from market losses, it exposes you to a different danger: currency debasement and inflation. Central banks always respond to crashes by printing massive amounts of money, which destroys the purchasing power of cash. So you need protection against currency collapse. That's where hard assets come in, specifically gold, something that maintains value when paper currencies and financial assets are disintegrating. Phase 3 is profit. You're not just trying to avoid losses or preserve wealth. You're positioning to make money from the crash itself. This requires instruments that increase dramatically in value as markets fall. Short positions, put options, credit default swaps, bets that explode upward while everything else collapses. Execute all 3 together and you've created perfect positioning. Trade 1 protects you from losses. Trade 2 protects you from currency destruction. Trade 3 makes you wealthy while everyone else is being wiped out. Then there's an implicit 4th trade that comes after the crash. Using the capital you protected and the profits you made to buy everything at fire sale prices when panic reaches maximum levels. But let me first show you exactly how this playbook has worked across 4 different market crashes. Trade number 1 is the cash conversion. This happens 12 to 18 months before the crash and serves as the earliest warning signal that markets have reached unsustainable levels. In 1929, Joseph Kennedy was one of the most aggressive speculators of the Roaring Twenties. He had made millions manipulating stocks through coordinated buying schemes and controlled massive positions across multiple companies. The market was in pure euphoria. Stock prices had tripled in 5 years. Ordinary people who had never invested before were borrowing money to buy stocks. Margin debt reached levels never seen before. Investors were putting down 10% and borrowing 90% to buy even more shares. But Kennedy understood something most people missed. When everyone is already fully invested and leveraged to the maximum, there's nobody left to buy. Markets don't rise without new buyers. And when prices start falling, even slightly, all those leveraged investors face margin calls. Brokers demand more cash immediately, or they sell your stocks to cover the loan. That forced selling pushes prices lower, triggering more margin calls, forcing more selling. It becomes an unstoppable death spiral. Kennedy recognized this pattern. Starting in the summer of 1929, he began methodically converting his stock holdings to cash. Not all at once, because dumping everything would crash prices and ruin his exit strategy, but steadily and systematically over several months. By September, Kennedy was substantially liquid. The Dow Jones hit its peak on September 3rd at 381 points. The crash began on October 24th, 7 weeks after Kennedy had already gotten out. While ordinary investors held on all the way down, watching their life savings evaporate over the next 3 years, Kennedy sat protected in cash, ready for his next moves. Fast forward to 1987. Paul Tudor Jones was running a hedge fund that had been successful trading commodities and stocks. But by mid-1987, Jones was examining market valuations and seeing massive problems everywhere. The Dow had climbed from under 1,000 in 1982 to over 2,400 by August 1987, a gain of 140% in 5 years. Price-to-earnings ratios were stretched beyond reason. Margin debt was surging again. And there was a new factor nobody fully understood yet: program trading. Computers executing enormous trades automatically based on algorithms, creating instability that traditional markets had never experienced. Jones ran the numbers and concluded that a crash wasn't just possible, it was inevitable and coming within months. Throughout August and early September 1987, Jones systematically reduced his long stock positions. He sent memos to his investors explaining that he expected a major crash by October. Not a vague warning, but a specific prediction with a specific time frame. He raised cash throughout September. By early October, Jones was sitting almost entirely in cash, prepared for trades 2 and 3. The market peaked on October 2nd at 2,722. The crash came on October 19th, 17 days later. Jones was already out. The 2008 situation is more complex because different investors saw the housing bubble at different times. Michael Burry started moving to a defensive position as early as 2005. He had been running a fund investing in undervalued stocks, but his research into subprime mortgages convinced him the entire financial system would implode. So Burry stopped investing in stocks, raised cash, and sat on that capital while preparing for the other 2 trades. John Paulson reached the same conclusion in 2006. He launched a dedicated fund specifically to bet against the housing market, requiring him to raise cash from investors for that explicit purpose. Warren Buffett, always the most cautious, had been building cash since 2006. Berkshire Hathaway's cash position grew from $40 billion in 2006 to over $60 billion by 2007. When asked why he was not investing it, Buffett said he couldn't find anything worth buying at current prices. Translation: everything is overvalued, time to get out. The market peaked in October 2007. By then, Burry, Paulson, Buffett, and others were substantially in cash. When the crash accelerated through 2008, they were protected. Which brings us to 2026. Warren Buffett is sitting on $325 billion in cash. Let me repeat that number: $325 billion. That's the largest cash position in corporate history, both in absolute terms and as a percentage of Berkshire's total assets. Buffett has been systematically selling stocks to raise this cash. He cut his Apple position in half. He's been selling Bank of America shares month after month. He's not buying anything new. In his most recent shareholder letter, Buffett stated explicitly that he cannot find anything attractively priced. That's not a casual comment. That's a coded message. Everything is too expensive. Get out. But it's not just Buffett. Jeff Bezos has sold over $13 billion worth of Amazon stock through 2024 and 2025. Mark Zuckerberg has been selling billions in Meta shares even as the stock hit all-time highs. Jamie Dimon, the CEO of JP Morgan Chase, sold company stock for the first time ever during his tenure. Insider selling across corporate America is at levels not seen since 2007, right before the last crash. These are the people running the companies. They see the actual financials. They see the real customer data. They know what's coming, and they're converting to cash. Trade number 1 is happening right now. The smart money is out. This is the exact same pattern as 1929, 1987, and 2008. Trade number 2 is gold accumulation. This happens simultaneously with the cash conversion, usually starting around the same time, 12 to 18 months before the crash. The purpose is protection against currency debasement and inflation. In 1929, after Joseph Kennedy converted to cash, he faced a new problem. The government response to the crash would involve printing money and devaluing the dollar. Kennedy understood this. So throughout late 1929 and into 1930, as the crash was unfolding, Kennedy was buying physical gold. Not gold mining stocks, but actual physical gold. This protected his purchasing power while the dollar was being debased through government intervention. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. Bernard Baruch, another legendary investor who profited from the 1929 crash, made the same move. Baruch had lived through the Panic of 1907 and knew that crashes always led to currency manipulation by governments trying to stabilize the economy. So Baruch converted to cash and then moved a substantial portion into gold. When the dollar was devalued in 1933 by Franklin Roosevelt, who reset the gold price from $20.67 per ounce to $35 per ounce overnight. Baruch's gold holdings increased in value by almost 70%. While everyone holding dollars lost purchasing power, Baruch gained. In 1987, Paul Tudor Jones didn't focus as heavily on gold because the crash was short and sharp. The dollar didn't collapse, but Jones still held some gold as insurance against the possibility that Federal Reserve response would be inflationary. That insurance wasn't necessary in 1987, but having it didn't hurt. The 2008 crash is where gold really proved its value again. Throughout 2007 and into early 2008, while Burry, Paulson, and others were raising cash, they were also accumulating gold. Paulson specifically made enormous gold purchases. When the crash hit and the Federal Reserve responded by dropping interest rates to zero and printing trillions through quantitative easing, gold surged. It went from around $700 per ounce in 2008 to over $1,900 per ounce by 2011. That's a gain of over 170%, while the dollar was being destroyed through money printing. Now in 2026, central banks around the world are buying gold at a pace not seen in decades. China's central bank has been accumulating gold every single month. Russia has been buying gold aggressively. Turkey, India, Poland, Singapore. Central banks added over 1,000 tons of gold to their reserves in 2022, the highest annual total since 1967. In 2023, they added another 1,000 tons. In 2024 and 2025, the trend continued. These aren't retail investors buying gold coins. These are central banks, the institutions that understand currency debasement better than anyone because they're the ones doing it. Why are central banks buying gold at these levels? Because they know what's coming. When the crash hits, governments will respond by printing unprecedented amounts of money. The dollar will be debased, inflation will surge again, and gold will protect against that currency destruction. Trade number 2 is happening. The smart money is accumulating gold right now. Trade number 3 is the volatility bet. This is the profit trade, the move that doesn't just protect you from losses, but makes you wealthy by betting directly against the market. This trade happens closer to the crash, usually 6 to 12 months before, once the smart money is confident about the timing. In 1929, Jesse Livermore, perhaps the greatest speculator who ever lived, spent the early part of 1929 building massive short positions. Livermore understood crowd psychology better than almost anyone. He had made fortunes in previous panics by betting against consensus. As 1929 progressed, Livermore accumulated enormous short positions across multiple sectors. He wasn't just avoiding the crash, he was positioning to profit from every point the market fell. When the crash came, Livermore's shorts paid off spectacularly. He made somewhere between $100 million and $140 million during the crash, equivalent to over $2 billion today. While the entire country was being destroyed financially, Livermore was getting richer by the day. In 1987, Paul Tudor Jones spent the summer building his volatility positions. Jones bought put options on stock market indexes. Puts are contracts that pay off when prices fall. They're pure volatility bets. If the market crashes, puts explode in value. Jones bought puts expiring in October and November, betting that the crash would come during that window. On October 19th, Black Monday, the market fell 22.6% in a single day, the largest one-day percentage decline in history. Jones's put options went from being worth a few million to being worth over 100 million in one day. One trade. Jones made more in that single day than most people earn in a lifetime. The 2008 version of Trade 3 is the most famous because of the Big Short. Michael Burry spent 2006 and 2007 buying credit default swaps on subprime mortgage bonds. A credit default swap is essentially insurance on a bond. If the bond defaults, the swap pays off. Burry was betting that subprime mortgages would default in massive numbers, destroying the bonds backed by those mortgages. Everyone thought Burry was insane. His investors demanded their money back. His brokers mocked him. But Burry understood the mathematics. The mortgages were garbage. The bonds were worthless. And when housing prices stopped rising, the entire structure would collapse. Burry paid premiums on these swaps for over a year, watching his fund lose money while waiting for the crash. But when it came, his credit default swaps paid off at levels that seemed impossible. He turned a few $100 million into several billion. John Paulson did the same thing, but on an even larger scale. Paulson raised a fund specifically to buy credit default swaps on mortgage bonds. When the crash hit, Paulson's fund made $15 billion. One fund, one trade, $15 billion in profit, while the global financial system nearly died. Now in 2026, the volatility bets are being placed again. Hedge funds have been accumulating put options on major indexes. The CBOE Volatility Index, called the VEX, has been showing unusual activity. Sophisticated investors are buying protection at levels that suggest they're expecting a major move down within the next 12 months. Bill Ackman made $2.6 billion in March 2020 by buying credit default swaps on corporate bonds right before the COVID crash. Ackman saw the pandemic coming understood it would crash markets and bought protection. When markets fell, his swaps exploded in value. He closed the positions, took $2.6 billion in profit, and then used that money to buy stocks at the bottom. The full playbook, all three trades plus the fourth. And Ackman has been signaling recently that he's concerned about market valuations again. He's been vocal about risks in commercial real estate, about excessive government debt, and about the fragility of regional banks. When someone who made billions from the last crash starts warning again, that's not casual conversation, that's positioning. The data shows massive increases in put option activity on major stocks and indexes. Someone is buying enormous amounts of downside protection. This isn't retail investors hedging their retirement accounts. This is institutional scale betting. Billions of dollars in put options positioned to pay off when markets crash. Trade 3 is active. The volatility bets are being placed. The smart money is positioning to profit from the collapse. Now let me connect this to what's happening right now. All three trades are being executed simultaneously for the first time since 2007 and 2008. That's the signal. That's how you know the crash is coming. Buffett is sitting on $325 billion in cash. That's trade 1. Central banks are buying thousands of tons of gold. That's trade 2. Hedge funds are accumulating put options and credit default swaps at levels not seen since before 2008. That's trade 3. The playbook is being executed in real time. The historical pattern says that when all three trades are active, you're 12 to 18 months away from the crash. Let me show you why the crash is inevitable by looking at the current setup. Stock market valuations are at extremes seen only twice before. In 1929 and in 2000, the S&P 500 is trading at a price-to-earnings ratio around 28. The historical average is 15 to 17. The only times valuations reached these levels were right before the Great Depression and right before the dot-com crash that destroyed 78% of the Nasdaq's value. But it's worse because of concentration risk. 7 stocks represent approximately 30% of the entire S&P 500 market value. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla. If these 7 companies crash, they'll take the entire market down with them. This concentration hasn't existed since 1929, when a handful of industrial stocks held up the whole market right before the collapse. Nvidia alone illustrates the insanity. The company trades at a price-to-earnings ratio above 65. Investors are paying $65 for every dollar of annual profit the company generates. Nvidia's total market value exceeds $3 trillion. That makes it worth more than the entire German stock market. This isn't rational valuation. This is speculation driven by artificial intelligence hype, the exact same dynamic as the internet hype of 1999. Real estate is more overvalued than during the 2008 housing bubble. Home prices are approximately 50% above their long-term trend relative to income and rent. At the peak of the 2008 bubble, homes were 35% above trend. We're 43% more overvalued now than we were before the crash that nearly destroyed capitalism. And commercial real estate is already collapsing. Office buildings sit 45% vacant. San Francisco has a 35% vacancy rate. These properties were financed when interest rates were 3%. Now those mortgages are coming due and need to be refinanced at 6 to 9%. The mathematics don't work. Defaults are beginning. Banks are taking losses. The cascade has started. Government debt has reached levels that make the system unsustainable. Total federal debt exceeds $38 trillion. Annual interest payments on that debt now exceed $1.2 trillion per year. That's larger than defense spending, larger than Social Security. The single biggest line item in the federal budget is interest on past borrowing. When your interest payments exceed everything else, you have 3 choices. Cut spending drastically and cause a recession, raise taxes drastically and cause a recession, or print money to pay the debt and cause inflation. All 3 options lead to economic crisis. The setup is identical to previous crashes. Extreme valuations, excessive leverage, unsustainable debt. The system is fragile. It just needs a trigger. The trigger could be anything: a major bank failure, a commercial real estate default that cascades, an unexpected geopolitical crisis, a recession that's worse than expected. The specific trigger doesn't matter. What matters is that the system is so overextended that any shock will start the cascade. Based on the historical pattern, here's the timeline. We're somewhere between month 12 and month 18 before the crash. That puts the crash window at late 2026 or the first half of 2027. It could be sooner if a trigger appears early. It could be slightly later if markets stay irrational longer. But we're in the window. When the crash comes, it will happen in phases. First, a crack appears, something breaks. Maybe Nvidia misses earnings and falls 20% in a day. Maybe a major regional bank fails. Maybe commercial real estate defaults spike. The initial crack usually happens 6 to 12 months before the full crisis. Then comes contagion. The initial crack spreads. Fear becomes self-fulfilling. Credit markets freeze. Nobody wants to lend because nobody knows who's solvent. This is what happened in September 2008 after Lehman Brothers collapsed. The entire credit system stopped functioning. Then comes intervention. Governments and central banks panic. They throw everything at the problem. Interest rates get cut. Trillions get printed. Banks get bailed out. Markets stabilize temporarily, and people think the worst is over. But it's an illusion. The intervention doesn't solve the underlying problem. And then comes the secondary collapse. This is when people realize the intervention didn't work. Markets that rallied on the stimulus start falling again. This time faster and farther because confidence has been broken. This phase is the heart of the crash. It typically lasts 18 to 36 months. Finally comes stabilization and reset. After the system has been thoroughly cleansed, after bad debts have been liquidated, after zombie companies have failed, the foundation for a new cycle gets established. But this only happens after years of pain. The investors who execute the three trades don't try to time every twist and turn. They position early. They build cash during the late stage of the bubble. They buy gold before the crash. They buy volatility protection 6 to 12 months out. Then they wait. When the crash comes, the three trades pay off. The cash position protects them from losses. The gold preserves purchasing power while central banks print money. The volatility instruments explode in value as markets fall. And then comes the implicit fourth trade. After everything has crashed, after panic has reached maximum levels, after stocks are down 50 to 70% from their peak, that's when you deploy. You use the cash you protected. You use the profits you made from the volatility bets. And you buy everything at fire sale prices. This is what Kennedy did after 1929. He used his cash and his profits to buy real estate, businesses, and stocks at depression prices. He bought entire companies for pennies on the dollar. Those purchases made him one of the wealthiest men in America. This is what Buffett did in 2008. In September 2008, at the absolute depths of panic, Buffett invested $5 billion in Goldman Sachs. He received preferred shares paying 10% annually, plus warrants to buy common stock. Within a few years, the $5 billion investment was worth over $12 billion. He more than doubled his money by buying at maximum fear. This is what Ackman did in March 2020. He used the $2.6 billion he made from credit default swaps to buy stocks that had crashed. Within months, those positions had recovered and he had made billions more. The fourth trade creates generational wealth, but you can only execute it if you successfully completed trades 1, 2, and 3 first. You have to have the capital. You have to have preserved purchasing power, and you have to have the psychological fortitude to buy when it feels like the world is ending. So what should you do? Most people can't execute this pattern at the scale Buffett or Paulson or Ackman do. They don't have hundreds of millions in capital. They don't have access to institutional grade credit default swaps. But understanding the pattern gives you enormous advantage. You can execute simplified versions of the three trades. Trade 1, raise cash. If you're currently 60 to 70% invested in stocks, reduce to 30 to 40%. Hold the difference in cash or short-term treasury bills. Yes, you might miss some gains if markets keep rising. But when the crash comes, you'll have capital protected. That capital becomes buying power at the bottom. Trade 2, buy gold. Allocate 20 to 60% of your portfolio, depending on your risk aversion, to physical gold or gold exchange-traded funds. Not gold mining stocks, physical gold. When the crash comes and the Fed prints unlimited money to stabilize the system, gold will surge. This preserves purchasing power. Trade 3, buy protection. You can buy put options on SPY, which tracks the S&P 500 index. Buy puts expiring in 6 to 12 months with strike prices 10 to 20% below current levels. You'll pay 1 to 3% of your portfolio value. If markets crash, those puts could return 5 to 10 times what you paid. If markets don't crash, you lose the premium. But that's insurance. You pay for protection hoping you never need it. The most important element is psychological preparation. When the crash comes, when markets are down 40 to 50%, when every headline predicts the end of capitalism, when unemployment is spiking and banks are failing, you have to be ready to act. You need a list of quality companies you want to own, companies with strong balance sheets, low debt, products people will always need. When these companies are on sale at 50% off, you buy aggressively with the cash you protected, with the purchasing power you preserved in gold, with the profits you made from volatility bets. You buy when everyone else is paralyzed by fear. This is the hardest part. Not the technical execution of the three trades, but having the courage to buy when it feels like the world is ending. That psychological fortitude separates the investors who get rich from crashes from those who lose everything. Kennedy had it, Baruch had it, Paul Tudor Jones had it, Burry, Paulson, Buffett, Ackman, they all had it. The willingness to act when fear is maximum. Here's the bottom line. The three trades aren't secret. They aren't insider information. They're a documented historical pattern that repeats because crashes follow the same mechanical sequence. Extreme valuations, excessive leverage, a trigger, forced liquidation, panic. The investors who see it coming make 3 trades: convert to cash, buy gold, bet on volatility. These trades worked in 1929, they worked in 1987, they worked in 2008, and they are being executed right now in 2026 by the smartest investors in the world. Warren Buffett is sitting on $325 billion in cash. That's trade 1. Central banks are buying thousands of tons of gold. That's trade 2. Hedge funds are buying massive amounts of put options and credit default swaps. That's trade 3. The pattern is playing out in real time. The only question is whether you'll recognize it and position accordingly, or whether you'll ignore it and hold through the crash, losing 30 to 50% or more of your wealth. Most people will ignore it. They always do. They'll believe this time is different. They'll believe AI changes everything. They'll believe the Fed will save markets. They'll believe valuations don't matter. And they'll lose everything, just like most people did in 1929, 1987, and 2008. But a small group will see the pattern. They'll execute simplified versions of the 3 trades. They'll protect capital, preserve wealth, and profit from the crash. And then they'll buy at the bottom and become wealthier than they ever imagined. The choice is yours. The 3 trades have been made. The pattern is repeating. The crash is coming. Position yourself while there's still time. Because when the crash is already happening, it's too late. The trades have to be made before the crash. That's the entire point. And before is right now. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.